Saturday, November 1st, 6 p.m. New York time. Welcome back, investors, to Winning Wall Street's Money. We just finished the month of October. We had the Federal Reserve meet Wednesday. They lowered the interest rates by 1/4. Not all the members voted to support that. 2 members voted opposed of that. Also, the head of the Federal Reserve made a clear statement that the meeting they have this coming December, less likely for them to lower the yields. These yields they control, or their overnight lending between the big financial institutions. I'm going to go over the yields from the U.S. Treasury Department. The ones that sell bonds, the ones that sell boats. Sorry, the ones that sell bonds, the ones that sell notes, the ones that sell T-bills. Yep, the U.S. Treasury Department. They sell fixed income products to raise capital to fund the United States government, because the United States government does not collect enough tax revenue, does not collect enough taxes and tariffs. We run a debt and we're only paying the interest. So you could buy these financial instruments directly from the U.S. Treasury, or you could trade them in the financial markets, specifically in the futures market, as well as stock ETFs on them. So the first one we're going to look at is the 30-year yield. That's the longer term investment, the longer yield. Far right grid, monthly, the middle, the weekly, and the left, the daily. The far right monthly, red, lower low, lower high. Still above the lows of this year, but the current momentum's down on the monthly. On the weekly, we made a reverse. Higher high, higher low. So the trend reversed here on the weekly. Again, this is the 30-year, the longer term. You're locked in if you buy it directly from the U.S. Treasury. And again, the yields are fixed. First, equity markets, speculation, higher risk in the equity markets, stocks. Where here, you know what you're going to receive. Let's go to the next one. Go to the 10-year one. Very popular, the 10-year one. Has the most liquidity, very correlated to the mortgages. So the monthly, lower low, lower high, made a new low for the year. Big difference than the 30-year. And for the week, it also reversed higher high, higher low. Yep. The prior week, interest rates for mortgages were lower. Now they went up. Let's go look at the 5-year U.S. Treasury. Also made a new low for the year on the monthly, or my bullish pin bar. And on the weekly, it reversed, broke above that inside candle, higher high, higher low. Again, this is the 5-year one, the shorter duration. And let's take it to the 2-year, the really short duration. Monthly, new low for the year. Weekly, reversal. So again, all of them on the monthly did make lower lows, lower highs. First, the weekly, we have trend reversals. Put this back here on the longer duration. Show you some history. 30-year yield. This is a 20-year chart. Here's the highs in the top left. Here's the lows. Much closer to the highs, the yield for the 30-year. Huge consolidation here. Here we are again, 20-year chart on the 10-year. Big consolidation, getting tighter as a wedge. So we did have higher ones in the past and lower ones. Now the 5-year yield for a 20-year history, huge consolidation. Again, we had the trend up, consolidation. More likely, the trend is going to continue back up. Higher yields, higher interest rates. And the 2-year. It broke that swing point from last year there. Interesting, the 2-year. There's a high, there's a low. Thank you as always for spending just a little time with me. That's it for the video. Thank you for watching.